What is self-dealing for private foundations? Imagine a private foundation using its funds to benefit someone close to its leaders. That's what self-dealing is all about. It's a serious issue in the world of nonprofit law. When a private foundation engages in transactions with certain people or entities connected to it, that's considered self-dealing. These people are called disqualified persons. They include foundation managers like officers, directors, trustees, and also major contributors. Family members of these individuals, such as parents or children, are also disqualified persons. The law aims to prevent these individuals from using the foundation's assets for personal gain. Examples of self-dealing include selling property from the foundation to a disqualified person or leasing property to them. Lending money or extending credit to these individuals also counts. Providing goods or services to disqualified persons, like paying them for consulting, is another example. Paying excessive salaries or reimbursing expenses beyond what's reasonable can also be self-dealing. If the foundation transfers income or assets directly to a disqualified person or for their benefit, that's a violation too. Even certain agreements to pay money to government officials related to the foundation can be considered self-dealing. The Internal Revenue Service, which is the tax authority for nonprofits, takes self-dealing very seriously. If a private foundation engages in such acts, it faces hefty penalties. The law imposes a 10% excise tax on the amount involved each year the act continues. If the violation isn't corrected within a certain period, an additional 200% tax can be added. Foundation managers who knowingly participate can face a 5% excise tax, plus other penalties. These rules apply whether or not the transaction seems fair or beneficial. There are some exceptions. For example, paying reasonable salaries to staff, reimbursing legitimate expenses, or renting office space at fair market value are allowed. Loans made at no interest or below market rates are also permitted. Sometimes, the foundation's creator might provide rent-free office space, which is acceptable. However, the IRS does not forgive penalties just because someone made a mistake or was unaware. Understanding self-dealing is vital for private foundations to keep their tax-exempt status. Strong governance policies help identify disqualified persons and ensure all transactions are fair and for charitable purposes. If a mistake happens, correcting it quickly can help reduce penalties. Staying compliant keeps the foundation operating legally and maintains public trust.